Okay, so good morning, everyone. Welcome to the new week. We are Monday, December the 1st. This is the macro snapshot, 2025. Of course, let's immediately see what's going on. We got some interesting comments last night from Ueda, which took the market slightly by surprise. Ueda, of course, is the governor of the Bank of Japan. There had been some sort of thought that the incoming Prime Minister Takeichi, she was a little bit sort of against any kind of hikes from the Bank of Japan. She wanted to more sort of stimulate the economy, have loose monetary policy. But so this is why the market was a little bit surprised because Ueda basically at the weekend in a speech said that he thought that if they delayed hikes too long, there was a chance of inflation getting out of control. And he also said that if they delayed hikes too long, there was the possibility that they may have to sort of have some much more aggressive sort of hiking later on. So he didn't explicitly endorse sort of a hike in this upcoming sort of December meeting. But basically, he sort of let it known that he's definitely thinking about that. And he also sort of said, reading between the lines, just reading the statement, that there didn't seem to be any explicit pushback from the prime minister about that, or sort of any political pressure. So essentially, what's happened is that the market has sort of reassessed a little bit and thought that maybe Ueda has in fact been in consultations with the Prime Minister Takeichi, and that she has essentially said, "Hey, if you think it's necessary, we don't want to have an inflation crisis. If you think it's necessary, hike interest rates." So it's not that the interest rate is definitely going to happen. The interest rate hike will definitely occur, but the market has increased the probability. So the probability has gone from 14 basis points being priced in for a sort of a hike in December. It's now up to 21. And you can see this reflected in something like the 10-year yield. So if you look here at the 10-year yield, this is a daily chart. So you see that yields have been grinding higher, but suddenly we had a bit of a spike overnight in the 10-year yield, also all across the Japanese curve. And of course, that also has been quite supportive for the US JPY, in the sense that for the JPY, for the Japanese yen. So let's just look at the Japanese yen here versus the US dollar. So you can see here US dollar versus the yen basically weakening. So it's been weakening for a few days, but again, explicitly that pushed it down. What's interesting is just in terms of the levels here, that it had been grinding in this uptrend, broke above the uptrend and was heading up towards this 160, 159.10 kind of level. Didn't quite get there. So this is going to be a very key. Let's just clean this up. It's going to be a very key moment here, because if we put on some moving averages and whatnot, let's bring down a few things here. If we put on some, sorry guys, I'm just going to bring on some EMAs here. You see on the longer term EMAs, we've now broken down below the 20-day EMA. Of course, we couldn't get up to that level. So the next key level is really going to be this downtrend line. Let's just draw something, around about here, which is going to coincide with the top of that breakout channel. So the 153.85 level, I think that's going to be the next key one. Or you could argue maybe it's down towards the 50-day EMA. Let's see if the Japanese yen does have sort of the juice and the strength to sort of push further below. Now, also, what's going to be interesting here, of course, you've got the US dollar on the other side of that. If we actually just look at the US dollar here, just put on the dollar index, you can see here that the dollar index itself rejected at that very key level around about the 200-day EMA, around just above 100. So you see here just above 100. So obviously a very key level there. It was rejected there. It's now down back down towards the 100 and the 50-day EMA. So potentially could be a bit of support there. There's also a little bit of horizontal support at 99. So we're getting into a key level. Now, what are the factors here which could, on the other side, move the US dollar weaker? Well, of course, it could be data. So we have coming up today, we have the ISM manufacturing at 10 a.m. So let's just have a look and see what's expected for that. Just give me a second here. I'm just going to bring that up. Macro data. I think I've got trading economics. Not bad for the calendar here. Let's have a look. So you can see here that we've got the ISM manufacturing here expected to, oh my God, all these stupid sales everywhere. Anyway, so we've got the ISM manufacturing. So the previous 48.7, so that's in contraction territory. Remember, anything below 50 is indicating a contractionary kind of response to the survey. Consensus here for 48.6. So definitely less than 50 is the consensus. And the point here is that if we get sort of a softer data for that, that's going to put weakness on the US. Although we have to keep in mind that we also have the PCE data, so personal consumption index, but that's going to be for the September period. So here we are, the 1st of December. The data is still taking many more weeks before we fully catch up. It's probably not going to be really until January or maybe even February of next year until the data is all caught up after the US sort of government shutdown. So the question is, how much sort of input or importance will the market place on the ISM numbers this week? I think it's going to be part of, let's call it the vibe. It's going to be part of the general sort of sentiment, sort of a story. So even if the data is old, if it constantly is coming in showing a weakening economy, that could put downward pressure on the US dollar. And you have to think that if it breaks through these levels here at about 99, as I'm just showing on the chart here, there could definitely be some downside. So as I say, let's keep an eye on ISM manufacturing today at 10 o'clock. We have the ADP payroll numbers coming in later in the week. And then, as I say, later in the week, have the PCE. In theory, we also have a Jerome Powell speech, but we're in the Fed blackout period. So that would be highly, highly unusual. And I don't see any particular reason or any sort of crazy data which would force or necessitate Jerome Powell sort of explicitly talking about what the Fed will be doing on their December 10 meeting. So as I say, for me, the way the data this week, it's really just to build a narrative. And will that build on, let's say, for example, the Beige Book, which was released last Wednesday. And the Beige Book seemed to indicate an economy which is doing relatively well. It's not exploding. It's not collapsing. It's ticking along, relatively in a relatively solid way. Although there were indications from the Beige Book from the Fed that in a lot of the districts that employment at best is flat. Employers are not really hiring, not necessarily doing mass firings, but certainly the employment situation is flat, and in some areas weakening somewhat. So that seems to be the situation, that we have an economy which is relatively solid, although employment weakening a little bit, and definitely people who are sort of, on the lower end of the income spectrum are cutting back their spending. And that's the kind of sort of analysis we've been getting from some of those big box stores and retailers, like Walmart and Target and these kind of people. That is the wealthier cohorts are continuing to spend. And, the numbers coming from the Black Friday sales are indicating, relatively solid spending, but at the lower end of the income spectrum, again, a little bit softer. So that seems to be where we're at. So all that to say, I don't think that's going to cause Powell today in another kind of speech to sort of really sort of indicate too much, because historically in this blackout period, the Fed members do not explicitly comment on monetary policy. Having said that, let's just have a quick look and just see what is priced in. As you can see here, if we look at the CME, just based on the futures contracts, at least, the market is pricing in almost like 90% chance of a cut. So again, if Powell does want to sort of come out hawkishly and say, no, 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 we're not cutting, like really he needs to do that at today's speech. But again, that would be unusual. And it looks at this point as though it's a given. Trump also indicated that he has made his choice for Fed chair. The betting markets, and it does seem as though it's going to be Kevin Hassett who will be the next Fed chair. Trump said he's going to announce that at some point before Christmas. Who knows? Today, next week, 2 weeks, Christmas gift. Who knows? One thing to keep in mind about Hassett is that he's very pro crypto. So we've obviously been seeing BTC having a bit of a sell-off. And so it's going to be interesting to see if, Hassett is confirmed, whether that will be a bit supportive for the general sort of crypto space and BTC in general. And just have a quick look at crypto. Basically, the fact that the Japanese yields were up overnight, US dollar down, that's put a bit of a risk off sentiment for certain sort of assets. And if we look at some of the yields, let's just have a look here. Let's have a look at maybe the 10-year yield. You see the 10-year yield in Germany pushing higher. We can also see in the US. Let's just take, I don't know, maybe, for example, the 5-year yield going up a little bit. And you see the 10-year yield going up here, and also the 30-year yield. So it's definitely at the longer end of the curve. We've seen those yields going up here. So we're seeing a little bit of steepening, because the front end of the curve is still, relatively anchored by the fact that the Fed will be cutting. And so if we just have a look here at the yield curve here, oh, that's the 30. I'm trying to bring up the yield curve. Yeah, you can see here, as I say, we'll get rid of the Hassett rumors. But you see here that the curve is sort of reflecting the fact that the US economy is okay. There's too much issuance. There's not enough fiscal discipline. So longer term yields are going up, whereas the front end yields are basically sort of anchored in a sense because it looks as though the Fed will be cutting and that the incoming Fed chair will be on the dovish side. So that means that the front end yields are anchored, as I say, and the long term yields are going up. So that's causing a bit of a steepening, and that's not ordinarily steepening. Excuse me, it's not ordinarily great for risk assets. And we're seeing something like BTC. If we have a look at that, the BTC, you can see here, it got to that level of support after the breakdown. So you see it was a pretty important level around about 92,000, but the market has whacked it over the weekend, and now we're getting pretty critical. You've got to say that the next critical levels are down here, where obviously recent low of about 80.7 thousand, and then all of these supports at around about 78, 77. So let's call it, approximately this sort of big. We'll just put a big box down here. So BTC under quite a lot of pressure here, and the general sort of crypto space. But again, that represents perhaps a buying opportunity, or otherwise, if it can't hold there, maybe a bit more sort of long liquidation here. Let's see what happens there. Now, talking about sort of other assets, obviously the big news as well is the big breakout in silver and gold, and in a certain sense copper. If you look here at silver, obviously a huge breakout. So first of all, technically, what's important to note if we just look at the moving averages here is that even with this big sort of retracement here, this was still, it was just back to the 50-day EMA here, where it was bought up, let's say about the 27th of October. That was still in an uptrend. So you can see that this sort of uptrend, which really broke out, let's say at the end of May, it's never really deviated, even though we've had a retracement, some consolidation. Then we had another sort of mini retracement back to a sort of 61% fib here. So this is still, as I say, technically you have to keep an eye on what the chart is telling you. It's still going up. So apart from the overall sort of macro background of the debasement trade, lack of fiscal discipline, US dollar being debased, the Fed chair being overly dovish, too much issuance, etc., etc. That's the big macro background. But more specific drivers for silver, we have a physical shortage of silver in the main global trading center, which is London. And we saw that squeeze. We did see that squeeze, a couple of months ago, but that still hasn't really gone away. There's a physical shortage of silver, so that is causing price rises. There's also just looking, this continuing Chinese demand, like real demand for real world applications. And the other thing as well is that keep in mind that silver was added to the list of critical minerals by the US administration this year. So the fact that silver was recently added to the critical minerals list means that it's now sort of almost like in the rare earth category. It's considered critical for the US military applications and indeed for the economy. And that means that the possibility of the potential for sort of tariffs or quotas in the US being imposed by the administration are omnipresent. And therefore, what's happened is that a lot of the physical silver metal has actually been moved into US warehouses by traders who are potentially sort of planning or hoping maybe for sort of quotas or tariffs, which would further boost the price of silver in the US. So the point is that there's actually quite a lot of silver in the US, but what's happening is that sort of all of that silver going to US warehouses is taking it away from the Shanghai warehouses and the London warehouses, which is causing a physical shortage. And voila, here we go, we're having a bit of a squeeze. So the point is that this squeeze is not purely financial, it is actually based on real world factors. Now, can it continue? Maybe. I mean, what we have to look at here is just the fact that, there has been a measured move. If you look at this Fibonacci extension going back to the breakout, let's say something like the 22nd of August, you can see that, we're starting to reach some profit targets here. And it is, for sure overextended. Although, as we all know, even if something is overextended, it can continue. I mean, what is also interesting is just to look at the general performance of silver versus, for example, gold. And I just want to put up here something to look at is the gold silver ratio, and you can see that gold was completely outperforming. So this is gold divided by silver, and you can see that historically this has always been the 70s, 80s kind of level, going all the way back to Roman times. This ratio has always been quite important. And you can see here the gold was really, really outperforming. But, in the last, sort of, let's say 2 or 3 months, silver has outperformed, and the ratio has come from gold being 100x silver down to about 73. But what you can see now, guys, is that this is at a pretty critical level here. And if this just stays around here and gold has a bit of a bounce, we could just see gold outperforming silver a little bit, and that could cool off silver. On the other hand, if silver continues to rip and we actually breach this level of about 73 in the gold silver ratio, that could fall all the way down into the 60s, and that could indicate more upside for silver. So keep a little bit of an eye on the gold silver ratio here. And just while we're at it here, I just got some numbers here, just looking at the overall commodities return. But you can see here that metals, precious metals here, silver, platinum, palladium as well, all doing very well, outperforming gold just in the 1 week. Obviously, year to date, in the last couple of years, the precious metals have done very, very well. So the point is that macro backdrop of people looking for safe havens, looking for debase trades to like real assets as opposed to like sort of fiat currencies, and obviously central banks still buying a lot of gold and in a certain sense some silver as well. So the precious metals doing very, very well. Let's have a look also at gold and copper. And if we just put that on here, if we look at gold, let's just put it on the futures. You can see gold also breaking out. So the point is here, the gold's also at a critical level. If you can break through this 42.85, that's going to be the first test. It looks as though this morning it's pushing higher. And, there's nothing really to stop gold maybe from testing these recent highs at 44.35 on the futures. If that's the case, you've got to expect silver to continue as well. And copper does seem to be coming along for the ride. Although, as you can see here, copper, the moving average is pushing higher, but we are at a very, very important level here, which is this sort of triple top. And we'll just sort of signal that with a nice little box, which also coincides here. So this is, actually, I don't like that pink one. Sorry guys, let me just replace that with a nick box. I want a nick box here. So we'll put this levels up here. So you can see this is a very critical level here for copper. So all of the metals pushing, copper's falling off a little bit. Silver and gold still pushing higher, but it wouldn't surprise me if we do get just a little bit of a pullback. So really the critical tell will be how if the bulls want to buy any dip, because obviously it's going to be a bit tricky to buy it at these nosebleed levels. So that's for that. In terms of other stuff, just want to have a quick look here at oil as we begin the week. We had the OPEC Plus meeting, and oil quite like that because over the weekend we had oil. The OPEC Plus essentially saying that they would, for the first quarter of 2026, they would keep the output unchanged. Although we have to say the fact that that's the case is signaling that they are worried about sort of surpluses. And you can see here there was a pop, a short-term pop in oil, but you can see at the 50-day EMA immediately rejected. So this is quite weak price action because if we put it, I don't know, let's say even like on a 3-minute chart, so a pretty short-term chart, you can see here that we did get a pop. So you see here, we had the meeting on Sunday, again, 3-minute chart. You can see that we gapped open last night on the futures, basically gapped higher, came back, and, but when Europe came in, immediately it has been whacked. So first thing to look out here, just from a critical, you see this level here, 59.09 on the front contract is obviously quite important. We also have this gap. So let's keep an eye on this gap. If the market, does not want to fill the gap, and let's say it stops around about 58, 90, 60 or something, okay, maybe it's a chance for oil to go higher. But so they're the levels to be looking at. But if you look on the daily charts, again, we still are in a bit of a downtrend. You've got the 20, 50, 100, and 200 still in a downtrend. And as I say, rejected at the 50-day EMA. So this price action is still trading heavy. And this is still a very, as I say, a very heavy market. And, the fact that OPEC Plus did not have the confidence to raise output, in one sense, you could say, oh, that's good because they're not adding extra barrels to the market. But on the other hand, you could also say this is sort of a cartel which is concerned about oversupply. So it looks as though oil is trading heavy. Other things to keep an eye on, let's keep an eye on the bonds just to see if they continue to sort of go up in the yields. We see the VIX now has popped a little bit higher, but it's still at levels which indicate over a 1% move per day. So VIX creeping a little bit higher here. And if we look at the equities, It's going to be interesting on these higher yields. Remember that we have the higher yields in the Japanese bonds, which is causing higher yields on the longer term bonds in the UK, Germany, and obviously in the US as well. Well, especially in the US as well. And so we're just seeing around about these highs here. Can the equities sustain this? Nasdaq normally does not like higher bond yields. So let's just see what happens today. And again, just to break this down to a 4-hour chart. Although Nasdaq and the equities, they did have a good bounce back. Let's just keep in mind, if we just put a Fibonacci here, let's say there's the reversal here, that if we look just from a fib point of view, this is stalling out now, kind of stopping and finding resistance at the 61%. So again, looking at just, this whole sort of downtrend, what happened and the fall, we can see here that the bulls have not been able to take it significantly above the 61.8 retrace. So you have to look at this sort of bounce here as not necessarily being a structural bounce, but maybe just more of a reactive bounce. So really, this is the key day today. Can the bulls really need to push that higher to say that this sort of fall off, this fall was nothing other than a restrictive reactive bounce here. So what levels might you want to be looking out for? Again, just in the 4-hour chart, what I would suggest is something like the critical next level, the next level which will be critical. Again, if we just do the reverse fib here, so if the bears take this down, really the bulls want to step in around about this 38% fib on this. So let's say 24,900, or maybe here at 24,725, or at a worst case scenario, 24,500. So really this levels here are the critical ones. The bulls need to sort of pick this up. If they cannot do that and it breaches down below, let's say 24,500, 24,600, that would indicate that this recent bounce was nothing other than a technical reaction, and that this downtrend may have more to go. So let's keep an eye on that today as the critical levels. Okay, guys, I've already spoken too much. Have a great trading day, and we'll be back with the macro snapshot tomorrow. Thanks very much and goodbye. Just going to stop it here.